Hi, I'm Paul Mahoney and welcome to Proper Wealth, the show where we discuss all things wealth creation with a focus on property. Joining me today is John Howard.
Hi Paul.
Property developer, author, speaker.
Thank you.
And we're talking about property as a secure asset class.
Yep.
Do you think we'll both agree that it is?
It is.
Yeah.
End of show.
That's it. We're done.
We're done.
Right. Let's start from the beginning and say, okay, if we're saying it's secure, what are we comparing it to?
Well, I would compare it to stocks and shares.
Yep.
I would compare it to gold. I would compare it to diamonds, perhaps. What do you think? What else could we compare it to?
Okay, in my mind, my background being financial planning,
Yep.
I only really view investments
Yeah.
as something that generates both income, well, at least something that generates income.
Yeah, I agree with that.
And ideally, the potential for capital appreciation as well. So therefore,
I think the appreciation is really, really important in that.
yeah.
Really important.
So I suppose therefore, in my mind, that's sort of interest-bearing investments, equities, as you say, and property.
Yes.
I would categorise things like diamonds and gold and that sort of thing as a commodity and therefore more of a speculation as opposed to investment. But I suppose that just depends on your definition of investment.
Well, I would say that allegedly diamonds have never ever gone down in value.
Fair enough.
Now, whether they manipulate the market a bit to make sure that happens, gold has, of course. Gold, we all know that if there's any turbulence, the value of gold goes up.
Yep.
And if it's an easy, lovely, everyone's doing well, it goes down. And actually, you could consider the central London property market up till now as being like gold, because foreign investors would always invest in the UK, mainly in the very smart bits of the UK, I accept that, and Mayfair would be an example of that, because there's turbulence everywhere else, and they know it's incredibly safe, they're going to be safe, and more importantly, their money's going to be safe.
Yeah, I agree. We can look. I've got some numbers on that. So far as the most recent financial crisis that we had in 2008. Yep. Obviously, that was directly property linked. It was a credit crunch. Yes. So the total average downturn across the UK was 16%. So it's about 8% in 2008 and about 8% in 2009, on average across the UK.
That's a bit disappointing if you want to take advantage of it, like I did.
Yeah, well, I'm sure there was lots of properties that were massively under,
and there was some
harder than that.
And we've got a portfolio in Brighton, for instance, and Brighton never went down.
Right.
It stayed the same.
Yeah.
And other places, of course, went down more. So the property world, the property market, especially in the UK, is and I heard you say this before, Paul. Actually, it's a micro. What's the word? Microcosm.
Microclimate.
Yeah. So there's like probably 500 different areas of which can all be slightly different for one reason or another.
Of course,
and of course, it's picking those areas and being smart about it. And there's an area near me on the Suffolk Norfolk border called Dis, which is a mainline to London, and that went up 10% last year.
Right.
So
yeah. So I think what you've heard me say in the past is important to understand the microeconomics of specific locations, rather than looking at the UK property market as a whole, because in my opinion, there's not really such a thing, because lots of people at the moment, for example, we're in London today. You speak with London people, they seem to think there's nowhere else in the world.
There isn't anywhere, is there, according to them? Some of them don't think they do anywhere but Mayfair, Paul. So we're doing well if they think it's the whole of London.
But that's the thing, and therefore, because the London market has been stagnating recently, they think the UK market is. Yeah. And
absolutely.
That's not necessarily the case
in
all cities.
I would agree. And over the years, I've been at it 40 years, and over the years, I've spread my investment across the UK, really. Yeah. That was partly because I just felt that I couldn't get enough of the right deals and the right margins just sticking to such a small area. But over the years, of course, that stood me in good stead. In the 90s, how old I am, Paul, in the 92 slowdown, property recession, 1992, we had blocks of flats in the Midlands and they went down 15%. East Anglia went down 35%. So you can see by spreading your risk around the place can make a huge difference.
Yeah, cool.
And can help you survive the recession. I've survived 3.
Yeah. Yeah, so a bit of diversification is a good thing.
Within the market.
Yeah.
Definitely.
I agree. One thing I would point out there with diversification, because you hear that a lot, you hear people wanting to spread their money as far as they can go.
It does depend how much you've got.
Yeah, I agree, and I suppose that's what I'm getting at. We speak with some people that they might have a couple of 100,000. They want to get sort of 4 or 5 properties with that, and really spread it quite thin. But then they're going into cheaper properties, cheaper areas, that sort of thing, and kind of just diversifying for the sake of it, as opposed to it being a good investment and then buying another good investment that just so happens to be in a different location.
And I think also over the years, the deals I've done, and I've done many, many, many deals. If you force that deal, if you force it to work, then, there's a balance between driving a deal forward and driving it to completion, and also allowing it to work naturally for you. Right. And if it doesn't work naturally for you, and going back to what you were saying about, the guy's got 200 grand, he's trying to force this, force that, it doesn't work.
Yeah, no, I agree.
Bit of patience. And I'm a deal junkie and I've got no patience. But you learn to be patient, because if you're not patient in property, it can cost you a lot of money.
Yeah, no, I agree. I spoke about the total downturn in property, and you said that is disappointing. And
for me, it's disappointing.
For you, it's disappointing trying to get the better deals.
Yeah, I want to get better deals.
But when you think about it, 16% is a small downturn, isn't it, in a major financial crisis? If you compare that to the FTSE All-Share Index, that fell by 32% just in 2008. So more than double, well, actually exactly double the total property downturn.
And may I say, I've never been any good at shares. So every time I've invested in shares, there's a disaster. And if you're a stockbroker, you don't want me as a client, because I can tell you what, it'll end badly. Yeah. Okay. So I've never done any very well with shares at all.
Yeah. And I suppose that there is a pretty stark difference between the security of shares versus the security of property, isn't there?
Well, the one thing I like about shares, it's a bit like being a car dealer, because a lot of car dealers become property dealers. But the difference they find, and where they really struggle, is with cars. If they need to out all their stock on a Friday afternoon, they could go to the auction, sell them all very within a few days. And the same with shares. You can cash in, I don't know sometimes how you do, but everyone does. Yep. You can cash in your shares. With property, you can't do that. You are committed to, even if you're going to put it in auction, it's probably 3 months.
Yeah, so long as there's liquidity in those shares and people are, there's usually a buy and sell figure.
Yes, I agree.
And so long as you go, below that sell figure, then you'll sell them if it's liquid.
If it's liquid.
Sometimes that can
with
dry
some
out
of my
as well.
shares, they went to nothing. So whether I used to quite like penny shares. They used to call them, I don't know what they call them now.
Small stocks.
Yeah, small caps. Penny shares. You'd buy them for 3p and hope they go to 12p. Yeah. It all sounded great, but all mine went to naught. Yeah, right. So,
which I think a lot of them do.
Well,
and I suppose that's my point. Is obviously when you buy shares in a company, your only security is that company.
Yes.
And a company can disappear overnight.
Yes.
Not necessarily due to anything untoward, just because the business fails. Whereas when you're buying property, it's a tangible asset.
It's a tangible asset, Paul, but of course it can go down. I mean, in the 92 recession, like I said, property went down 35%. In East Anglia, for instance, and up north less. But if you've got 65% gearing on that property, you've got no equity. You're what we call underwater in the trade. And it could take 5 to 10 years to get out of that situation. And of course, the bank may want their money back in the meantime, but they have it revalued, for instance. And so, well, hang on a minute, you either got to put a load more cash into this deal, or we're going to take it off you and sell it.
Well, I think that depends on the finance you've got in place.
Agreed, it does.
With most buy-to-let mortgages, they're not able to do that.
No.
But if you've got more of a commercial arrangement in place, then
it's interesting, Paul, and very interesting you say that, because in 2008, 2009, a number of the banks we were with did exactly that to us. So they came to us and said, right, we know you can pay us the money back. You can refinance it somewhere, whereas a lot of their clients couldn't. Yeah. So they said to us, right, we're going to revalue it anyway, but whatever the outcome is, whatever the value is, we want you to refinance it within 6 months.
Right.
And the funny story with the Brighton stock, which actually went up when they valued it from last time, it hadn't been valued for 4 years. It went up. They went, well, this can't be right, it must be fraud. I said, excuse me, we don't do things like that. They had it revalued again, at our expense again, by the way. They made us pay twice, and it came out the same valuation with another valuer. So they said, oh, well, we still want the money back. So it didn't do, we still had to pay it back.
Yeah. Yeah, I suppose that does show the importance of obviously understanding the finance you're putting in place.
Absolutely.
Not that you didn't understand it, but I'm just saying that for anyone else.
We might have had a 12, 15 million overdraft or something, and we might have been, and we weren't even using it all. But the point was that they felt we could pay it back, and they had a lot of clients that couldn't pay it back. So of course they came to the ones who could, which is a little bit unfair sometimes, because what you find is some of these more, how can I put it, rascally like people, shall I say, characters, would just, they live the high life. When things are great, it's brilliant. They're great to go out with for a night out, by the way, but never ever do any business with these people. When things are bad, they dump the bank, start again, and of course they're better off in sometimes because they haven't held on to their stock to start again with a fresh bit of paper, and that isn't really fair on the rest of us.
Well, that's true. Okay, so we're talking about property as a secure asset. I suppose one of the key things, if you're holding property, is actually having a tenant, isn't it? Especially if you've got your finances.
It's quite useful.
Fairly useful.
Although, may I just say something on that one? In Ireland, where they'd never had a property recession ever, and we used to go over there on a regular basis to see some friends and so on. Every year they say, oh, here come the Englishmen. They think we're going to have a recession. That was about 2004, 3, 4.
They definitely
2.
had one.
They definitely had one. And guess what? And you say to them, I see you bought a flat, David, a friend of mine over there. Oh, yes, he said. I said, what rent are you getting? He said, what do you mean rent? We keep it clean. I said, what do you mean by that? I said, well, no, we keep it clean. We don't rent them because we're going to sell them again for a vast profit in 2 years' time. And I was on the phone to him, and this is absolutely true. He's on the phone, and I'm listening to him, and he said, no, I can't take 900,000 for that. Put the phone down. He said, well, do you remember that flat I bought 3 years ago for 250? It's now worth 900. 950. I've only been offered 900. He was insulted. I said, David, you need to get back on the phone and take it, because guess what? It's all going to go wrong. Guess what happened, Paul?
Went wrong.
It went wrong.
All right, we need to go to a break now. Join us after the break for more discussions on property as a secure asset class.
Property is a great investment option, but it's one of the largest purchases that you'll ever make. As individuals, we're all limited by our resources, and regardless of our experience, knowledge or time, we can achieve much more with the help of a qualified team and extra resources being available. Nova Financial specialize in assisting clients to achieve financial freedom through property investment. With over 100 years of experience, we shape your family's future. To invest in property with absolute confidence, call us on 0203 8600 or visit nova.financial.
Hi, I'm John Howard, and I'm known as the property expert. The reason for this is over the last 40 odd years, I've bought and sold over 3,500 properties, and I'm still going. I'm delighted to pass on my vast experience and knowledge to you through my property seminars that are taking place across the UK this year. To know more, please go to johnhowardpropertyexpert.co.uk.
Meet the Author is a brand new mini-series involving leading experts in the property industry, including mentors, developers, property lawyers, and other industry experts who share insightful stories about their journey and their books. Each book is compiled by authors with years of valuable experience, tips, and observations, providing you with new knowledge about the property industry. To find out more, visit the website property-tv.co.uk/library.
Hello and welcome to Property TV. I'm Stephen Galpin, host of Property Question Time. We've completed the filming of Series 1, over 260 successful episodes. We're now about to film Series 2. The difference? Well, we're going to be filming in our new studio adjacent to the Canary Wharf development. Keep those questions coming in to us, keep our panellists, our experts busy, and we hope you enjoy the new series as much as you did the last one.
Welcome back to Proper Wealth. Today we're discussing property investment as a secure asset class, and joining me again is John Howard. John? Okay, so before the break we spoke quite a lot about property as a secure asset class, why it's secure versus other asset classes. We spoke about sort of some of the opportunities in boom and bust type situations.
I didn't depress you, did I, with all that?
Well, I think something that's worth touching on when we talk about those types of cyclical upturns and downturns is how to, in some ways, protect yourself against those downturns, because we all are going to experience them.
Without question.
Property is a long-term investment, and it'd be great if we could all sell the day before the bus and buy at the bottom, but that's not how it works.
Well, it is and isn't, Paul. I mean, I think there's telltale signs when a recession is coming. First of all, property recessions on average once every 17 years. So are we closer to a recession now than we were in 2010? My maths isn't great, but it tells me that we are. I think everyone would agree with that. And what happens quite often, people really know it's coming, but they don't want to believe it. Having survived 3 recessions, there's telltale signs. Obviously, I have to tell you, you're a very bright man, and you advise people. Car sales stall, employment. There's more unemployment. There's lots of and of course, one of the biggest things is mortgages. So there's so many things that tell you that things aren't great.
It's interesting that you raised those 3 points, because car sales are at an all-time high. Unemployment's at an all-time low, and mortgage availability is at an all-time high.
Hey, we have no problems.
So we're in good economic times.
Fill your boots.
Based upon those 3 things. And I think that's a good point, actually. The UK economy actually is pretty strong at the moment.
Very good. It's a lot better than the rest of Europe, that's for sure.
There's lots of uncertainty in people's minds around political instability and the B word, Brexit, and we won't go down that rabbit hole. But actually, once that resolves itself, which hopefully it will soon, I think things are going to continue on their merry way in quite a good positive fashion.
I think the one great thing about property, and I've listened to you speak on different occasions, and the one thing you get across very, very well is the fact that actually you can borrow this money so cheaply at the moment, over 25 years or whatever, and your return on your actual capital you're putting in yourself is really high. And it's a very, very good argument to buy and invest for long term in property.
I obviously completely agree.
No, you're modest, I can tell.
Look, I think something that a lot of people overlook when it comes to leveraged property is that they focus a lot on the actual gross returns on the asset. Rather than on the cash they're putting in.
And can I say, Paul, I would be guilty of that. I would be guilty. I know I'm very hard-nosed. I've been brought up in a different era to yourself, for instance. The markets were different and funding was difficult to get, unlike now where there's so much opportunity for people, so much funding available and so much good advice that you give and other companies like you can give. And these it's so easy for people now to do it, and a lot of them are taking advantage, and that is great, but they do need the right advice.
I suppose just to put some numbers to that when we're talking about leverage, we generally aim for a net yield on funds applied of between 5 to 10%, which is pretty achievable in the current market, and not bad going. That's obviously just one side of the equation. The UK average from a capital growth perspective over the past 20 years is 5.5%. And that includes 2 recessions, as you say. So if we scale that back to 5, we've got a 75% mortgage, 5% on the asset value is 20% on our cash. Now that puts you at 25 to 30% a year.
Now, Paul, that is of no interest to me whatsoever. But to the long-term investors, that is brilliant.
That's my point.
And if they've got another job, that's fantastic. And if eventually they have enough that they don't need another job, brilliant, absolutely brilliant. And they'll be sitting there thinking, well, 30 years ago we've got all these properties we bought, the mortgages all paid off on them or whatever, and we're worth a huge amount of money. If people start young enough, they can't really fail. Because if you look at the property market over the last 30, 40, 50, 60, 70 years, it's only gone one way. Build costs won't go down. Land, they're not making it anymore. I don't know if you heard that, but they're not making land anymore. There's a massive demand. There's 1 million more people in the UK every 3 years. And one National Health Service can't cope. everything is going the right way for property.
Yeah, I agree.
What about diamonds?
Diamonds, I don't know anything about diamonds.
Well, I know they haven't gone down, but they course.
I know I bought an expensive one for my wife at one point.
So did I, funny enough. Very good. Yeah, they used to say you should spend 3 months of a man's wages for engagement ring.
Okay.
I'm sure the amount you earn, it's probably only a month. It's very interesting. Gold the same. I mean, gold again. We've spoken about gold.
Yeah.
Gold versus property is an interesting one, because I mean you've got it's capital. It's all you're doing is protecting your capital. You're getting no income from it. So I mean, I think for me, property outsmarts that.
Yeah, I agree. Gold obviously does very well in bad times.
Yeah.
Because people view it as a safety net.
Absolutely, yeah.
So maybe having some gold is sensible. I don't have any.
Me neither. Funny enough.
Can't really get my head around having gold. Where do you keep it?
Well, the thing is, if say you've got £100,000 worth of gold, you put it in a vault, by the way.
Right.
Yeah. Not the one that got robbed recently. So you put it in a vault. Obviously, you never see the damn thing. That's the other problem with it. But of course, if you put £100,000 worth of gold, cash, it's got to be cash. Yeah. You buy the gold, £100,000. You could actually buy a property. If I gave you that £100,000 to you, for instance, you would probably buy me 3 properties with it, because you gear it up and all the rest of it. So, I much prefer but you just need to know and be prepared for the odd downturn over 30 years. If you're borrowing the money over 25 years, you're going to see probably 1.5-ish, 2 downturns.
Yeah. And
you have to be realistic about that and sensible.
And I think the key to depends what we're talking about, obviously. For property development, slightly different, because there's time frames on that.
Well, to be blunt about it, you're on the line.
Yeah.
And
exactly.
if you get the timing wrong, you've got you've done 20 odd properties, all empty, all with interest running on. You can't sell the damn things. You're in trouble. Yeah. So that's very different to what the sort of investment you do, for instance.
When we're
clients.
talking more passive, as you say, longer term,
safer, much safer.
It's very important to try to mitigate the risks associated with those
agreed.
Downturns.
Yeah.
Obviously, you are likely to take a hit to your capital value at some point.
Of course.
But in my eyes, that doesn't really matter so much, so long as your property's rented.
And also, as long as the building society or the bank can't do what they do to the developers, which is when you're borrowing over 5 years, the term comes up, oh, guess what, we don't want to carry on.
Yeah.
If they can't do that, and most of the buy-to-let mortgage, they can't do that, can they, I believe?
That's right.
Then you're pretty safe, aren't you, really?
Yeah,
very safe.
Yep, so long term, low cost,
yeah.
And as you say, with no ability to recall the mortgage, so it is quite safe.
Yes.
The only other risk, aside from having a tenant, is the cost of the borrowings, which is harder to control, but you can stress test. You can.
And also, the first 5 years of any mortgage are probably the hardest. A bit like marriage, really. First 5, you get used to each other and a few rows in between, because you're just setting the scene, aren't you, for what's going to happen going forward, probably. Yeah. But the first 5 years are probably the hardest, and after that, after you paid 5 years worth of, we've got 5 years of rent and everything else.
We've got 3 left.
3 left. Congratulations. So after that, it gets easier. And I think that's what you find. The people I speak to who they're very inspirational. These young people I speak to who, in their early 20s, they've saved a deposit or they've managed to borrow a deposit and they're going to buy their first property. They haven't gone on holiday with all their mates. They've saved their money. Yeah. And I always say to them, by the time you get to 30 and you've got 3 or 4, 5, 6, 7 properties, and your mates have just carried on going on holiday, you're going to be laughing at them because they're going to be stuck with nothing in the bank, and you're going to have a load of properties. And good luck to them.
Yeah, absolutely. And that's one person's scenario where they're kind of capping their lifestyle a little bit to get to improve themselves. But there's various other situations that I come across, like business owners, for example. Mm-hmm. So many business owners I meet with, they've got just excess cash sitting in their bank account doing nothing. And that can just do so much better in property, and you can build a property business alongside your own business, which can work really well.
And you know what I say to people when they say to me, "Oh, look, John, I bought my first property. I'm going to give up work. Oh my goodness! Please don't give up work.
We spoke about this.
We have, and it's madness, and it's scary. You know, if somebody's got a good an income, keep the income coming in. Yeah. And if it's a business and they're earning good money, and they can fund property deals out of that, that's a fantastic situation to be in.
Yeah, well, I used the example in one of my talks yesterday, so far as if you've got a profitable business for 10 years, let's say, and you're able to buy 1 or 2 properties a year because of that. Absolutely. Well, 10 years down the line, you've got 10 to 20 properties, which is a business in itself.
It is a business itself. And if you look at the hard, people like me who are developers and investors, we have to take out a lot of money every year to live off. And by the way, the longer you go and the more successful you are, the bigger entourage you have, and the more it costs you you don't want a downturn or two, otherwise, it's difficult. So we're constantly taking money out to live off. Well, if you don't have to do that, you just let it grow naturally. It's fantastic.
Absolutely. Yeah, multiple income streams.
Very good.
Key to success.
There we are.
I think that's all we've got time for now. Thanks for joining me, John.
It's an absolute pleasure as usual, Paul.
And thank you for joining us again. Join us next time on Proper Wealth.
Property is a great investment option, but it's one of the largest purchases that you'll ever make. As individuals, we're all limited by our resources, and regardless of our experience, knowledge or time, we can achieve much more with the help of a qualified team and extra resources being available. Nova Financial specialize in assisting clients to achieve financial freedom through property investment. With over 100 years of experience, we shape your family's future. To invest in property with absolute confidence, call us on 0203 8600 or visit nova.financial.
My name is John Howard, and I've been investing and developing properties for over 40 years. In that time, I've been very successful, but of course I've always made the odd mistake as well. In my book, I explain how to be successful and what to do should something go wrong. I've survived 3 property recessions. I can help you do the same. My book is available online. Please go to johnhowardpropertyexpert.co.uk.
The antiquated village of La Roche-Becourt in rural Dordogne may not have the cachet of Paris or London, yet it houses one of the 10 fastest growing property consultancies in Europe. It is home to Leggett Immobilier, the leading international estate agent in France. They have around 16,000 properties for sale right across the country, with a network of 400 agents who provide local expertise and market knowledge. If you want to know the best villages, schools, restaurants or boulangeries, then the Leggett team will know the answer. As well as advising buyers on the local market and regional property prices, they also have a bilingual contracts team who ensure that your purchase will go through as smoothly as possible. Leggett has been voted Best Estate Agent in France for the past 4 years running. To experience these exceptional service levels for yourself, then head to our website, leggettfrance.com.
Meet the Author is a brand new mini-series involving leading experts in the property industry, including mentors, developers, property lawyers, and other industry experts who share insightful stories about their journey and their books. Each book is compiled by authors with years of valuable experience, tips, and observations, providing you with new knowledge about the property industry. To find out more, visit the website property-tv.co.uk/library.
Hello and welcome to Property TV. I'm Stephen Galpin, host of Property Question Time. We've completed the filming of Series 1, over 260 successful episodes. We're now about to film Series 2. The difference? Well, we're going to be filming in our new studio adjacent to the Canary Wharf development. Keep those questions coming in to us, keep our panellists, our experts busy, and we hope you enjoy the new series as much as you did the last one.